Thank you very much for taking part in the panel today. Gold, how's it doing? Is this finally the year that gold breaks out, spreads its wings, reaches for the stars? Should we start at the end with the analyst, Samson? Your thoughts on, maybe we'll start off with the gold price.
In the short term, we think gold price may consolidate further at this, like, about slightly above the 1300 level, because obviously the geopolitical risk in Korea is retreating, but at the same time, it looks like the relationship between China and the U.S. and Russia and the U.S. are getting worse. And at this moment, we also think that the dollar is on the higher trading at a higher range right now, like above the 90 level for the dollar index. So we think the dollar index could retreat back to like sub 90 level. So in the second half of the year, so in the short term, we think the gold price could consolidate further above the 1300 level. But in the longer or the medium term, like for example, especially in the second half of this year, we think geopolitical events and the possibility of further volatility of the global stock market could create more demand for physical gold as safe haven asset. And we think in an optimistic scenario, we think gold price could see above 1500 this year.
Above 1500 this year. That is quite optimistic. Kevin, from Franco-Nevada.
Well, I'm delighted. I'll have a different take on it because we focus very much on the U.S. dollar gold price, and my focus. I'm focused on Australia, and what I've noticed that's interesting there is that when the gold price came off its peak back in 2011, the Australian dollar also came off its peak, with the result that, while the gold price dropped 30, 35%, whatever, I don't know the exact percent, you will, but the Australian dollar also fell. And so in local currency terms, the gold price is, $1,650, $1,700 an ounce, same as it was 7 years ago. Sustained record gold prices for a significant country producer. If you're in Australia producing, you're not making bucket loads of money. You have only yourself to blame. You can't blame the commodity price, or you can't blame cost pressures like maybe you could 7 years ago. So my take on it is it's you also have to make a call on what's the U.S. dollar going to do. And I have difficulty seeing weakness in the U.S. dollar. I mean, obviously the news these days is a bit chaotic, but I think the larger picture is they're talking about interest rate. Getting into a rising interest rate cycle, so it's tough to see that. It's tough to see a weakening U.S. dollar. So if you're calling for higher gold prices, I say you've got to see other factors at play there, and obviously you do. So,
can Trump mess up the sort of strength of the dollar?
He's trying, but I think what they're showing is the resilience. On the one hand, one man can make a difference, but also one man can also very much not make a difference if it's all just talk and no action. So,
Samson, do you have any comeback on that?
Yes. Personally, I think the financial market is more complicated than we all think it is. For example, like gold peaked in year 2011, exactly the time when the Federal Reserve announced the commencement of QE3, which doesn't make sense because, the Fed is printing more money, enlarging the monetary base, yet the dollar starts to rebound. And right now, I think the reverse is actually what is happening. First of all, the global market already expects the U.S. interest rate cycle is continuing going up. However, first thing is the global market is also expecting the interest rates on other major economies, especially the Britain and the EU, is going up as well. So the interest rate gap between the US and, let's say, Euro is actually narrowing right now, and that's why the dollar is getting weaker. And secondly, I think that it is the best interest to the the U.S. government or U.S. the country that the dollar is weak. For example, since 2008, the financial tenacity, the global financial crisis, the U.S. government needs to work on everything to gather the global capital from the overseas back to the U.S. in order to support the domestic economy. But right now, I think the economy is fine. So they revert back to the old way, is to export the useless dollar in exchange for physical commodities or useful service. So I think, and also consider that from the government perspective or from a personal perspective, the debt level in the US right now is higher than the level before year 2008. So from a perspective, the financial problem has not been solved. It's actually getting more high leveraged these days compared to global financial crisis. So higher interest rates or on the higher debt is going to kill the global economy again. So in the longer run, I think, yes, the U.S. interest rate will continue its on an uptrend cycle, but the so-called interest rate normalization is probably much lower than everybody are expecting right now, because the U.S. and from a global perspective, we can't have a very high interest rate. Otherwise, again, the whole economy will be destroyed. So I think it is good to gold and commodities.
Sure, sure. And what do you think these rising debt levels are going to do for inflation, or are they going to create more risk of inflation or damp down the chance of inflation and lead to deflation? Maybe. Stefan, do you want to?
Well, I think one of the things that's an underlying reason to believe that there's upside risk to gold at some point is that overall systemic debt levels continue to go up. That this sort of addiction to debt in all the major economies hasn't been, still hasn't been really grappled with or dealt with. So I think this is still a big risk. So when I think of gold as a commodity class, it's difficult for me to know, when it'll jump or for what reason it may go up, up or down in the near term. But I think generally speaking, I view the risks for it to move upwards as being greater than the risk that it'll move downward. If we look over the last 18 months, we started last year with a very strong Trump trade. We started with interest rates moving up. The dollar for a while was having a period of strength, and none of this had as much of an impact on gold as potentially one could have thought it could have. So I think gold has actually been fairly resilient when sentiment was very strong. I think sentiment today is not quite as strong, and there are risk factors. One of them is the risk of higher interest rates, higher debt levels, and higher inflation. And gold should do well in that environment, I think.
So if Samson suggested 1,500 by the end of the year, what would be your take on where the gold price will end up at the end of this year?
I probably wouldn't put a figure that high for the end of this year. I don't see any particular catalyst that'll get it there, but it will be catalyst driven, and there are, it could be a geopolitical risk issue that gets us there, but there'll have to be a distinct change in sentiment, I think, for gold to jump to that level. But it could happen this year. I mean, these tend to be events that happen when people aren't predicting them.
Andrew, your thoughts on the gold price, and what are your analysts telling you? What's Michael telling you is going to happen?
I don't know. He's over there. What do you think, boss? No, I mean, as Stefan says, I think the gold price has proved remarkably resilient on the factors we analyse it by, in which our interest rates have risen, and they've risen in real terms, not just nominal terms. Not risen a lot, but they have risen at the short end quite a lot. Alternative risk asset prices, stocks, property have continued to do very well. The only thing that's changed, but interesting, gold prices have gone up quite a lot before, is that volatility's gone from abnormally low to more normal levels, and that's normally supportive of gold. I absolutely don't rule out a correction in gold if the risk asset bull market continues, which the consensus outside this room is that, you know, we're in a bull market for stocks forever, and for Asian real estate forever, and for Hong Kong real estate forever. That will inexorably push up certainly nominal interest rates and will reduce the attractions of gold. People are bored with gold at the moment, but it can be worse than bored, I can tell you. So I don't rule out gold retesting levels, I don't know, somewhere in the 1200, 1250 zone. But I think it's bottom, and it's, you know, our forecast has been, we haven't won any prizes recently for forecasting, although I think we've got it pretty right, is that gold would trend higher, but with low volatility until such moment as it had a breakout. But that breakout would be most plausibly associated with a significant rise in volatility and a real break in risk asset markets, and a clear understanding that real interest cannot rise given the levels of debt, and that debt, credit, not interest rates, credit is a very, very risky asset. So that's how we see people herding out of all these alleged safe havens back into gold, is terror of systemic failure in the financial system at some point, and concerns about all sorts of things, conversation, taxation, and default. But that's kind of like forecasting World War I in 1912. It might be early. I think we're getting closer. I just think you're crazy not to have a meaningful allocation of gold at this point. It's one of the very, very few ways to hedge that scenario. You might be wrong about it, but if we're right, and it does happen, most of your other assets are going to fall by 50, 70, 90% on past form. And gold's got a good chance of going up 2 to 3 times. So you might just about, if you have 20% in gold, you might just about stand still, which is not a bad outcome. Your purchasing power will have risen. So I'm extremely bullish with an 80% probability on a 1 to 5 year timeline, and I'm agnostic in the shorter term. But more concerned about the correction than most. You know, I buy, every time we get up to the old highs, I buy some gold puts or find some overvalued, big ugly mining major gold companies to sell some bums, which we try to short.
Kevin, you look like you.
Yeah, just following on this a bit, I don't know if it's bad manners because I'm kind of going to ask a question. But one of my thoughts on gold, because I remember being at a conference, I don't know, 20 whatever years ago, and the CEO of Anglo Gold got up and started talking about scenarios where the gold price might go to $400 an ounce. And he said, but you know, if you imagine those scenarios, this is when the gold price was $250 or something. And he said, if you think about what those scenarios are, that's not the sort of world we want to live in, because it's a disaster scenario. It means things are falling apart and there's chaos and blood in the streets and whatnot. And yet what we saw was a gold bull market during a time of prosperity. And you know, my thinking on it is tuned. I think gold's a stock, or not a stock. Gold's an asset that works at both extremes. It works both as a luxury in good times and as a safe haven in bad times. And maybe it's just when things are kind of mediocre that gold kind of gets boring. People don't feel rich enough to buy it. They don't feel scared enough to buy it either. And that's just my own personal thought. But I'm just curious if anybody else thinks that has any merit here.
Any comments on that?
Yeah, I mean, I think the key comment about gold at 250 is it was trading at half any sensible producer cost. I mean, it was crazy cheap. Gold isn't, on our estimation, crazy cheap now. It's very good value, particularly in fact in its lack of correlation, its hedging characteristics, its insurance characteristics. But I mean, you're the experts, and you tell me what, on average, gold costs. We're going to talk about it, but I mean, you know, it's 1,000-ish, maybe a bit less, but true economic costs, get out of bed, make a gold mine, it's probably $1,000 an ounce. With 20, 30% above that, that's not a huge premium, by the way, but it is certainly a premium. And at the bottom of the gold market in 2000, 2001, we were trading at 40, 50% discount to what it cost to produce in real economic terms.
That brings us smoothly on to discuss how the mining companies are performing, and certainly the question on cost. Do you have any figures, you can share with us on the cost of production?
Yeah, last year, global cash cost is about $650 per ounce, and AISC is about $872 per ounce. Both the cash cost and the AISC, this is a global average, right? And then both the cash cost and the AISC increased around like 3 to 4% year on year, mostly because the cost of power, including oil, increased, and B, secondly, is a weaker dollar makes producing nations in non-dollar countries like Australia, Canada, and African countries all went up. The most severe region is probably South Africa. The grade actually increased by more than 10%, but still the cost, because of a stronger local rand and again, a higher oil price or diesel price, the production cost in South Africa actually rose like 19% last year compared to the year before.
But as the US dollar has strengthened again, are you going to see that flip again this year? Obviously, the fuel costs are still going up.
Yeah, it definitely helps, but again, looking at the oil price is still gaining momentum. It looks like, and I think that in some way, currency is similar to commodities. Like they are seldomly 1 year wonder. Like when they develop a trend, the trend usually lasts for years. So like last year is testing. Last year is probably the first year that we see that the dollar start to weaken. The dollar index fell from above 100 to like around 91 at the end of last year. So this is a signal that I think the dollar weakness will continue for at least maybe this year and maybe carry forward to next year. And from a technical analysis, when something that is supposed to go up but it didn't and it actually fell, that means the momentum is very strong that it will continue to fall. So I think the dollar is the case that it will continue to fall in the next, probably this year and maybe probably next year as well.
I think perhaps I'm not very familiar with the South African context, but one of the problems in a lot of emerging countries is that you're fully US dollar based. So you've got your US dollar cost, but also your contracting costs, everything is US dollar. And so that can also be, I think, a challenge with emerging market mining investing in general. And as Kevin was alluding to in Australia, that's what's very attractive about non-US developed markets like Australia and Canada, where you can get that really nice currency tailwind behind you. When that currency is weakening, their actual cost of production in US dollar terms goes down dramatically. And that's the narrative we saw in Australia over the last several years, for sure.
Are those the countries offering the best value at the moment, do you think, then, in mining stocks?
Well, I think that narrative in Australia is now a narrative that everybody's aware of. I think finding good value has become more challenging, and basically to find value, I think generally you've had to either move towards the illiquid space. So good value has come at the cost of liquidity, which can be very painful in its own right when things don't go the right way, or you're going to pre-production. Or other esoteric reasons, why there may be a value gap.
Okay. So, in general, I mean, you've mentioned there that some of the stocks, their value has gone up quite a lot. What does our panel think about how mining stocks have performed? Earlier in the day, some people were saying they've slightly, feel gold equities have slightly disappointed this year compared with maybe the base metals and the battery materials.
Well, I think if you're just looking at this year, I mean, equities have moved, started the year very strong. They moved up. Everybody, at least most people, I think, were feeling pretty good at the end of January, and then things have, traced back a bit since then. But if you take a longer-term view over the last 10 years, I think, generally speaking, there's been far more discipline. Costs have still been maintained. So far, labor costs still have not been a big issue in markets like Australia. But I suspect that at some point we may start seeing tightness in labor market, and some of those costs starting to creep back up.
Have the miners been able to do anything in terms of automation and streamlining their operations to try and sort of mitigate the risk of rising labour costs as the market improves? Since the last cycle, I mean,
I think in the small mid cap, in the small and mid cap space, I think I've personally seen less of that than the majors. Have been who have a much higher cost base to begin with. They've been plowing a lot of money, to try to find ways to make automation work better for them. But
yeah, I think like when the story first comes out about driverless trucks or driverless trains or something like that, and you hear they're working on it, it makes a bit of news. But then it turns out years down the road, you've still got real drivers in the trucks and in the trains, and it turns out that all this stuff is slow and expensive and difficult, and so it is happening. I think they have driverless trains now, but it took them years and years to get to that point. So I don't expect anything revolutionary. I just expect it's going to be the slow creeping change. I'm looking forward to the day when we no longer send people underground, and I think that'll change. Dynamic or cost dynamics differently. If you don't have to design your underground operations to fit humans, and instead it's just remote controlled equipment, what does that do for how you can design and mine?
are you seeing any new technologies coming through to enable that, such as sort of in situ leaching sort of operations or whatever, sort of like they do in the uranium business, for example?
No, not seeing it. The only ones that you hear about it from these days are the ones who have challenging projects, who have to come up with something novel to try and answer the question of why their project doesn't have a fatal flaw.
Yeah.
But so it's certainly not mainstream.
Fair enough. One of the questions I wanted to ask today was about the impact of Bitcoin and even the battery materials boom on the appetite for gold and gold equities. And the question being really, since Bitcoin has kind of fallen off from its, hitting 1900 high, and now it's down at 19,000 high, now it's down at, what is it now, 7,000, something like that? Anyone know the Bitcoin price these days? But anyway, are we likely to see more retail interest come back to gold stocks, given that the sort of people who were investing into Bitcoin often were the same sort of people who were, anti-fiat currencies and, wanting to hold gold coins?
that narrative of Bitcoin, of gold buyers switching out of gold to buy Bitcoin was a really attractive narrative, and we all read it, but I'm not sure how material that was and how many people were actually doing that.
I'm not sure how many people who are gold buyers or gold investors also went into Bitcoin. It strikes me as a different sort of investor group, but I could be
kind
wrong.
of survivalism. It's because sort of NRA going out and buying Bitcoin. I don't think so. You might move one step to the right to buy gold, but nah. It's just speculative flurries, and it wasn't particularly gold. It was whatever's hot. I've made the joke before, but I'll make it again. I mean, next year I'm confident that we'll have a whole slew of what's displaced gold and Bitcoin, as we all know. Next year we'll all be talking about Bitweed, which will be crypto cannabis, and half the stands out there will be crypto cannabis Bitweed players. But no, it's just where new speculative activity takes place. And I don't think most of the buyers of gold are that. I think most of the buyers of gold are rather conservative people who are concerned about, and the gold shares concerned about the frailties in the system and the overvaluation of conventional assets.
I mean, I think what is interesting is just to think about what who is the last large marginal buyer of gold that actually affects, movements, the most, whether it's retail or central bank buyers. But, central banks, I think generally, and you probably can speak better to this than me, but are still, at the end of the day, accumulators, right?
Do you have any figures on central bank buying? I'm looking.
Not in the top of my head, but I remember that Russia was probably the largest buying central bank, the largest buying country last year, and it looks like Russia will be again another the largest central bank buying of gold this year. But I think that especially to the medium and smaller size exploration companies, actually they are more difficult to get capital from investors, especially retail investors, because I'm an active participant of an overseas stock trading forum, and I know that lots of high net worth investors or speculators, they were actually putting money into cryptos or anything related equities last year that could have been putting into resource equities as well. So definitely, I think the rise of cryptos last year had a negative impact on the resource equity market in general.
There we go. I've got a question here. It says, where next for the Pilbara Gold Rush? When we were at the conference last year, in fact, some of you have seen the videos here. I think you've got a nice little sort of pile of melon seed. There it goes. There it is.
I think that's Artemis.
Exactly, Artemis over there. So,
I had their shares for a while.
what's going on with that? Can anyone share any light on where next for that?
I wish I could say something about that because I should, but it's kind of gone quiet.
Very quiet.
and not necessarily in a bad way. It's not like something's come out saying, "Oh, this is all just amounting to nothing." I think maybe they're just finding it's more work to prove things up, and so there's not the big rush of regular results and stuff that people are expecting.
Andrew, any thoughts? Just
No, exactly
nodding
that.
agreement.
It's all gone very quiet at the back. It was a thesis. It was unproven on the way up. It's unproven on the way down. Until it's proven, probably there'll remain some reasonable interest. And it's probably more a fade away than bust.
Yeah, I think one thing people might
Well, unless it's true, in which case it'll be the best story on earth again.
it's a very common to go out and mine nuggets in Western Australia. There's a lot of private small scale prospectors go out. They do it as a hobby. They make money out of it and stuff like that. I think that was different was the investment thesis that you could find a field big enough and rich enough that you could put some economies of scale in there and a big mining outfit and make $1 billion company out of it. I don't know.
I can't tell or forecast whether it could be for real or just hype. But one thing that I noticed that is there are lots of quality people working in the industry actually start working in that area as well. For example, the people from NextGen, they spent maybe 1.5 million cash and plus shares that totaled close to maybe a 4 million deal, just trying to get a project in that area. And then also Chris Mullen of Golden Valley, the group is also working in that region as well. And some famous Australian people working in the industry, for example, like Tolga Komova and Klaus Eckhoff, they're working in Blaze International, again, working in the region as well. So I think these people, their willingness to work in this area show that they think there is some interesting prospect, at least in that region.
Interesting. Do we have any questions from the audience for our panel of experts here? Don't be shy. Stick your hand up. There we go. Question at the back here. Can we grab a microphone over here? Thank you.
Hello. Can the panel comment on the, in terms of the gold holding by the different solvent? It seems like, that China has not been aggressively buying. And can you comment on, the solvent holdings changes?
Like I said, sorry, it's not in the top of my head. So, but I know that Russia has been the largest buyer for the past maybe 2 years or so. China is a little bit hard to tell because, to be honest, things just work differently in China compared to other countries. Like even, for example, like a state-owned bank, technically, its assets belongs to China as well. So maybe with just a click of button, and then the central bank can easily just buy gold directly from, let's say, ICBC. So like it's really hard to tell whether like China is willing to buy to increase their gold reserve or not, because it's pretty flexible for them. And I know that the Chinese central bank at least was buying gold overseas, but obviously they are not telling you they are buying. So like everything is being handled secretly or like under the table. So it is still quite hard to speculate how much the Chinese central bank actually is holding gold reserves. But I can tell you that I attend a presentation by ICBC like 2 or 3 years ago, and they speculate that the Chinese central bank is holding much more gold than they officially declared.
Remembering that China is, by some way, the largest producer of gold. So we don't know, on the trade flows, it's not exporting, so it is accumulating. Question where it's accumulating.
Yeah. And I think if you look across other commodities like, nickel or copper, clearly, 10, 15 years ago, you could rely on LME statistics to sort of give you a good global picture. Today, that just doesn't work anymore. You have to be pulling Chinese data sources to try to figure out what the Chinese angle is. So it's probably the same with gold. I think it's just more difficult to quantify the number.
What's the best source of information on Chinese gold?
The gold price relative to the environment, and it's been edging up, which tells me China's patiently accumulating.
Fantastic. One of the last topics I want to talk about is M&A, resource replacement, M&A opportunities on the rise. Panel, any thoughts on if this is the year that everyone's going to start buying stuff?
Well, you're already starting to see some M&A, and I think this constant tension of what some of these companies actually have cleaned up balance sheets as of the last few years and are starting to accumulate pretty serious amounts of cash. They don't want to be buying back stock. They don't want to do an extraordinary dividend or increase their dividend rate. So I think you are seeing some companies buy strategic stakes in other businesses or start talking about M&A, and that's something to be probably careful about if you're invested in the business.
I think that's absolutely the case. If you look at the producing gold companies, got to replace their ounces. The bigger they are, historically, the worse they've been at finding them at reasonable prices, and they've been even worse at buying them in the market. But at some point, greed prevails over fear, and they'll be back. But it's bubbling under. You're seeing regular deals in the small and medium parts of the market. We haven't had a blockbuster deal because the market won't allow them to do that yet. But as soon as they're let out of the loony bin again, they'll be back with their checkbooks paying crazy prices, and I hope we'll be there selling to them. But I think it'll take some time. We'll need to be further into the cycle than we are now.
Yeah, I just say the same thing. I think what we see is the small sort of rationalization deals of the little bolt-on acquisitions in a district where you can operate something better and save on capex. Not the sort of hero merger deals, the big company transformation deals. I think that's a ways off later in a market cycle. And the other thing is it's got to be exploration driven, in the sense there's got to be a discovery that triggers a round of bidding and activity and district play and stuff. So we haven't seen that big discovery in a while. And so it's all small deals. It's all sort of chewing away at the edges.
Are you going to see more of this cash going back into exploration? Companies hiring more geologists and drilling more holes?
No, nobody's talking about it very much.
Are they just going to be, M&A is going to be the way to go rather than exploration? Checkbook over drill bit. No comment from the panel there. Fantastic. Any final questions from the audience before we wrap up this very interesting session? If not, then thank you very much, guys, for that. Lots of topics covered there. Please do grab our panelists afterwards. But in the meantime, quick round of applause.